Pierre, I know you're a bonds guy, but can you maybe tell us what the heck is going on with these markets right now? When I see an inflation print so hot in the U.S., why are we seeing a risk rally right now?
Yeah, good morning. So indeed, the inflation print from last night in the U.S. did show that inflation was quite hot. Obviously, 0.6% months and more for core is definitely very elevated. I do think that it wasn't all doom and gloom to some extent, so maybe that explains some of the rally that we see. I mean, if you look a little bit under the hood, it showed that potentially inflation is stabilizing at a high level, but stabilizing nonetheless, or at least that it's not going even higher, or that prices aren't becoming unanchored. I also think the the core goods numbers, flat month on month, were actually reassuring that this transition from goods inflation to services inflation is actually happening as expected. And finally, really, the high number, the breakout number was shelter inflation. But we know that there's always a bit of a lag in the way that the BLS calculates shelter inflation. So in a way, it kind of reflects changes in housing prices, in rent prices from 6 or 12 months ago. So maybe there's some for everyone in that report.
Pierre, you look at this. How will the Fed interpret these numbers? I mean, it probably just adds to the it's more grist to the mill for them, isn't it?
Yeah, absolutely. I mean, this is not what the Fed is looking for in terms of being able to pivot to a more dovish monetary policy. They want to see some decisive and forceful indication that inflation is moving down, and that's not what we got yesterday. I do think it probably means that rates are going to stay higher for longer, and that the Federal Reserve again is going to have to do jumbo rate hikes in November and in December. I think after that is when it gets interesting, when interest rates are at 4.5%, 5%, and maybe inflation is still relatively sticky. What does the Fed do then? Hopefully they won't continue to blindly increase interest rates, because that would really increase the chances of a hard landing in the U.S.
Okay, Pierre, you mentioned there might be something for everything and everyone in this inflation print, but it also raises a lot of questions about, how important the macro is in determining investment decisions now. Do you think the market can build on this rally moving forward, or do you think the shorts, they're just going to keep establishing new positions at higher levels? What's your take on what comes next?
I think ultimately, over the long term or the medium term, I do think fundamentals and the macro is important. I think inflation data, labor data, economic data in the U.S. is going to be of the utmost importance over the next 6 months. That being said, if you look at fixed income, my asset class, I think there are reasons to be more constructive nowadays, and even if interest rates stay higher for longer, I think a lot of the adjustment has already happened in bond markets.
Yeah, absolutely. So, when you have a look at these bond markets, be it corporate or sovereign debt, are you looking perhaps at some of those investment-grade corporate bonds which have probably fallen perhaps into the high-yield camp? And where do you find quality in high yield? And how do you, forgive me for saying so, separate the wheat from the chaff there?
Yeah, so we would agree with that point. Investment grade corporate bonds, or maybe BBB rated corporate bonds, or even higher quality, high yield corporate bonds are now looking interesting again. I think even if you do get a mild or potentially a severe recession in the U.S., those types of companies that make up these indices have tended to be very resilient, even in past economic downturn. So we do think that the downside is limited. And again, just because of the carry, or if we get some positive news on inflation, or if maybe growth falls down a little bit quicker than anticipated in the U.S., you could see yields come down, and therefore you could generate substantial returns for investing in that asset class.
I said one of your contrarian views is UK IG credit. Maybe you could walk us through the thinking behind that, and why anyone would want to touch UK assets, just given the multiple U-turns we've seen when it comes to this budget.
Yes, you're right. Volatility has increased quite substantially in UK assets ever since the mini-budget announcement on the 23rd of September. To be honest, the sell-off has been quite severe, and we actually think that, again, in the more resilient, high-quality UK companies, those maybe with international exposures, banks as well, financials, we think are well capitalized and relatively robust. So there could be opportunities in the UK bond markets, again, given the sharp correction that we've seen over the last 2 weeks.
Pierre, I want to get a sense of what you made of what Andrew Bailey's been doing at the Bank of England, because it does seem as though this is a gamble to end this buying program Friday, i.e. today, later today. What do you make of that, and do you think he did the right thing?
I think the Bank of England is obligated to stick to their stance, which is this is an emergency intervention. This is not QE again. We are not financing the budget deficit of the UK government. We have just stepped in because there were significant threats to financial stability, and that's their position. And of course, hopefully they don't want to intervene again next week or subsequently. They hope that market forces can regulate government UK gilt yields on their own, and that's their positioning and that's their talk. But to be honest, if gilt yields increase again and are a threat further and threaten further financial stability in the UK, the Bank of England will have to intervene at some point in the future.